And we're back with you to take a look at your ag commodity trade. I'm Marlon Bowling with you. Well, let's take a look at this grain market, which fell precipitously after we opened up the trading session today. Let's take a look at our live prices from Chicago. Still big losses in the corn market. We have July down 7 3/4. We're trading at 348 1/4 right now. But I guess if you're looking for silver lining, it is 6 cents off of its earlier low this morning. We have December down 8 1/4 at 369. And if you take a look at soybean trade, a little bit ago it was down about 50 cents or 51 cents on November. Right now, November is down 45 3/4. There for a brief period, I was watching it tick by tick there, and it was actually up about 35 cents lower or so, and then it fell back again now. So now we're down 45 3/4 at 885 3/4, well off of our overnight high of 929. By the way, the nearby July soybeans are down 46 right now at 862 1/2. In the wheat market, they are not immune from this sell-off. We have July Chicago wheat down 18 at 472. Let's look at Kansas City wheat. Right now we have the July KC wheat down 24 at 475 1/2 as the wheat harvest activity really ramps up in Kansas. Trying to stay ahead of the rain that could be coming in a few days. Looking at the Minneapolis wheat, we have July now trading 16 1/2 lower at 547 1/4. Cotton market too has really getting punished today. Look at this, July down 346 at 83.86. And all the other months are now limit down 4 cents lower all across the board from October on out. Scott Gecus joins us now from the trading floor in Chicago, where all the action is taking place, and he is with Longleaf Trading. Thanks for joining us here, Scott. Got your hard hat on today?
Yeah. It's a crazy day. Again, I've been saying this for the last, 2 months or so. There has been no trade one way or the other. It's all been headline risk, as you can see today. If you look at the chart in all the grains, it's just a full-on panic. I was on yesterday talking about that 900 level in soybeans. You've seen it pierce that with heavy selling, heavy liquidation. It closed above it. I said before that, if we can get a close below that 900 level, we're going to test around 850. And sure enough, we came in today and it blew right through 850, which was the 215 lows, and then obviously we pop all the way back. So it's definitely going to be all about the headline risk going forward. We're going to see what the retaliation with China is going to actually come out and be.
Now, there is one point to be made here, and I was reading where the South American production, they're really snapping that up. Now, I have heard that buyers, foreign buyers outside of China, are taking advantage of this, and they're really snapping up the Brazil and Argentina soybean production this year at these discounted prices. And that means there isn't going to be a whole lot for China to choose from after this. And then where else are they going to get it? They're going to have to buy it from here, right?
Yeah, they're going to have to, and just like I said, earlier, with all the things going back and forth with Brazil, Argentina. Don't forget, a few months back they had that crash into the port where they already came out and said it was going to take 6 to 12 months to get it fixed. So with that also being a factor, yes, they're going to have to buy U.S. soybeans. It's just a matter of when and how much.
So is there a different fundamental at work in the wheat trade here? I mean, I know it's harvest time. This seems kind of severe for a harvest low.
Yeah, and the wheat market is, out of all the grains, they're the one that's staying steady. I mean, it's still strong liquidation across the board in all the grains across the board, but the wheat market is definitely the one that's most resilient. So you still have that strong liquidation going on. The winter wheat harvest was 27 versus about 14% last week. Export inspections, where it came in about the middle of the range. That 460 level is going to be just a number that we're going to keep an eye on.
Okay, and a quick look at our value of the U.S. dollar, too, and then we'll take a break here. On the U.S. index, the dollar index value, we have the September futures now 300 points higher at 94.750. Scott, we'll come back in just a moment. We'll analyze our livestock market when we come back. Lots of turmoil, lots of trade talk, and lots of gyrations in the markets, not just the ag commodities, but also in the Dow. We showed where the dollar was up about 300 points. The Dow going the other way today, and it is down over 300 points, down 329. Check that, down 330 right now at 24,655, and really gyrating around. Crude oil trade today. This market has also been bouncing around quite a bit here in recent days, and we have July West Texas crude dropping $1.29 line now at 64.56 per barrel. August futures down $1.28 right now at 64.41. So big time drop there. Diesel fuel prices or heating oil, they are related. We have the July contract on heating oil now down basically 2 cents at 211.3 per gallon. Now to the live cattle trade. Let's dive into our livestock futures. We have June live cattle down 42 cents, August down 48 at 104.70. But I should point out that that has now elevated off of its earlier low by $1.40. We have October now down 58 at 107 even per hundredweight, and that has come off of its daily low by about $1.30 right now. We're back within about 30 cents of our high of the day. What about feeder cattle trade? Well, of course, feeders always keep one eye on that corn market. We have August feeders, after posting a low today of 146.95, they have now come back to trade at 148.57, so that's only 40 cents lower now. September down 32 at 148.80. And on the lean hog market, here we go. We have the nearby July down $1.80 at 81.92, and that's exactly $1 off our earlier high today. And let's take a look at August. It's down 2.04 at 77.38. Scott Gecus rejoins us now from the trading floor in Chicago. And Scott, your reaction here on the livestock action today?
Yeah, the livestock stock action today it's still, with the cattle market, it's pretty much in a very tight range between 102 and 104. You're going to remain bullish above 104. It's still got that gap to move up. We just got to see how it's going to come out. The trade war talks is definitely playing a factor. There's fear that this trade war talk is going to spill over to the economy. So if the economy has a negative effect, then people aren't going to be going to the store buying their beef and pork. So that's definitely a factor into that. That feed report is showing and confirming that there's a little bit of that summer demand that's slowing down a little bit earlier than expected. So that feed report was a little bit off, slower placements. So we're going to keep an eye on that and going forward and see how that's going to play out.
On the beef cutout values yesterday from USDA, we had the wholesale beef trade showing the choice cuts. If we can pull that up, it was down 88 cents yesterday. However, you had the cheaper price select cuts, the lower price cuts like hamburger, etc. They were up $1.47 at 204.20. Is that typical for this time of year here, just due to barbecue season like that?
Yeah, that is typical just due to just barbecue season and stuff like that going forward. But, that July 4th is going to be a big number. We're going to need better than expected across the board, all-time highs in July 4th consumption to sustain any type of bull sentiment in the hogs and in the cattle.
In the lean hogs, once again, let's take a look at those futures markets on the lean hog trade. And in Chicago, we have that August contract down 202 at 77.40. Yesterday, the plant-delivered cash hogs were lower. That kind of puts an end to that trend. They've been higher for quite a while. Is this the end of the bull run, do you think?
I think it might be, but again, we'll see. There's nothing but negative news out there for the hog market, so we're going to see how that all is going to play out. They're running into supply concerns. Now you have the tariff talks, Mexico, Canada, and China. They're about 50% worth of U.S. all production, so that's definitely going to come into factor, running into those supply concerns.
All right, thanks, Scott. Scott Gecus of Longleaf Trading in Chicago.